Imagine one narrow strip of water capable of shaking the entire global economy. This is the Strait of Hormuz, a slim maritime passage between Iran and Oman that serves as the most crucial choke point for energy on the planet. Every day, about 20% of the world's oil and a similar share of global natural gas shipments move through this channel, connecting producers in the Persian Gulf to markets in Asia, Europe, and beyond. Now let's consider the unthinkable. What if Iran decided to close that strait completely? Most analysts call it unlikely because the economic consequences would cut both ways. But the mere threat of closure has already rattled markets and revealed just how fragile the global energy system can be. The first impact of a closure would hit energy markets almost immediately. With such a large chunk of global oil supply suddenly taken off the map, prices would soar. Some forecasts from major economic advisories suggested that in a serious disruption scenario, crude oil prices could spike well above $100 per barrel, potentially reaching $120, $150 if the blockage persisted. Higher energy costs would ripple outward, pushing inflation rates up as the cost of gasoline, diesel, and virtually every product that depends on transportation would rise sharply. Even before any actual closure, oil benchmarks have jumped on fear alone, demonstrating how sensitive global markets are to the strait's security. The shock wouldn't stop at oil prices. The global supply chain relies heavily on maritime routes, and nearly 90% of international trade moves by sea. Should the Strait of Hormuz be blocked, ships would have to reroute around the southern tip of Africa, a journey that adds thousands of miles, weeks of travel time, and dramatically higher fuel and insurance costs. The result would be severe disruptions to trade, higher costs for goods worldwide, and deeper inflationary pressures. Countries that depend most heavily on Gulf energy exports would feel the pain first. In Asia, major importers like China, India, Japan, and South Korea receive the vast majority of their crude and liquefied natural gas through Hormuz. Any prolonged disruption would force these nations to tap strategic reserves and compete fiercely for limited supplies, intensifying global price volatility. Even in the United States, where direct imports from the Gulf make up a smaller share of total oil consumption, the knock-on effects would be felt across the economy. Higher fuel costs feed directly into transportation and manufacturing expenses, raising the price of everyday products for consumers and complicating monetary policy decisions. Market volatility would increase as investors reacted to uncertainty, with energy stocks typically rising while more vulnerable sectors could see outflows. Financial markets would also face stress. Insurance premiums for vessels transiting the region have already risen in recent months as risk perceptions increase, and a closure would push those premiums even higher. Banks and insurers would reassess exposure to oil and shipping risks, and credit conditions for related industries could tighten. It is important to recognize that the act of closing the Strait of Hormuz would also be deeply damaging to Iran itself. The Iranian economy depends heavily on oil exports that would be halted by such a blockade, a move analysts have described as economic suicide, precisely because it cuts off Iran's own revenue stream and risks antagonizing key partners like China, which buys a large share of Iranian crude. It could provoke a strong international response, potentially even military, from major powers that have a vested interest in keeping the strait open. Beyond energy, extending a closure would raise the specter of a broader economic downturn. Some estimates suggest that a prolonged disruption could shave nearly a percentage point off global GDP growth, tipping fragile economies toward recession and deepening vulnerabilities already present after years of pandemic era upheavals and geopolitical tensions. Yet even as analysts warn of these dire consequences, some argue that the world's major economies have tools to soften the blow. Strategic petroleum reserves, particularly in the United States and Europe, can supply emergency oil to markets in the short term. Both the US and China, as the world's two largest oil consumers, hold significant stockpiles that could help stabilize supply temporarily. Still, these buffers are not enough to fully offset the loss of a major export route like Hormuz for any extended period. A blockage would expose structural weaknesses in global energy infrastructure and trade networks that cannot be solved quickly. Whether it lasts days or months, the shock would resonate across economies, affecting everything from fuel prices to inflation, trade costs, and financial markets. In many ways, the real power of the Strait of Hormuz lies not just in the oil that flows through it, but in the fear of what might happen if that flow were stopped. The prospect alone drives market volatility, compels governments to prepare contingency plans, and serves as a reminder of how interconnected and delicate the global economy has become.